Welcome to the Deep Dive, the show where we take a stack of sources and really pull out the key insights for you. Ever looked at a super successful business and just wondered, how exactly are they pulling that off? Or, maybe seen a company that seems to be doing everything by the book, but they're still struggling.
Yeah, it happens all the time.
And often, the real story, it's not just in the big profit number, right? It's hidden in the little differences, the deviations from their plan.
Exactly. Those small shifts tell you so much.
So today, we're diving deep into variance analysis. It's a fundamental tool, really, for figuring out what went right, what went wrong, and how a company's performing.
Absolutely essential.
Our mission here is to cut through the jargon, make it practical, and show you the real actionable stuff from the sources we've looked at. Okay, so let's unpack this. Imagine like you've got this super detailed map for a road trip. You know exactly where you're going, how much gas should cost, everything.
Right, the perfect plan.
But then you actually do the trip. You find a cheaper gas station, maybe take a scenic route that uses a bit more fuel, you hit some traffic, but maybe you drive faster elsewhere and arrive early anyway.
Reality happens.
Variance analysis is basically like going back over that trip log, pinpointing every single spot where you differed from the original plan, whether it turned out good or bad for you.
And what's fascinating really is how these numbers, which can seem pretty dry on the surface, actually tell a really compelling story.
About what specifically?
Oh, about everything.
Yeah.
How efficient the operations are, the impact of strategic choices, even how quickly the company reacts to changes in the market. It's all in there. Which brings up a key question, doesn't it? Once you have these insights, these variances, how do companies actually use them? How do they feed back into making things better?
Good point. So to really get variance analysis, we need to start with the basics, the foundation. At its heart, variance analysis is it's looking closely at the differences, right?
Yeah.
The gap between what you expected to happen in a budget, the standard, and what actually happened.
Spotting those deviations, that's the core idea.
And the system that makes this possible is what you call standard costing.
Exactly. Standard costing systems, it's pretty common. Instead of just tracking what they did spend, companies using this system also measure what they should have spent.
Okay, should have spent. Based on what?
Based on standards they set beforehand. Think of standard costs as the company's best guess. Their carefully calculated expectation for producing something.
Like raw materials, labor.
Yep, raw materials, direct labor, and also manufacturing overhead, those indirect costs. For direct costs like materials and labor, the standard cost is usually just standard price times standard quantity. Pretty straightforward.
Okay.
For overhead, those indirect costs, it's a bit different. You use a standard predetermined rate, and you apply it based on a standard quantity of something, like maybe labor hours or machine hours used.
I see. So you're setting a benchmark. But
Yeah.
why go to all that trouble? Setting these super precise standards, then measuring every little difference. Seems like a lot of setup work.
It can seem like it, yeah. That's a fair question. But think about it. Without those standards, you're kind of flying blind, aren't you?
I suppose so.
That effort is exactly what gives you the clarity you need for cost control. It provides clear numbers for performance reviews. It creates this feedback loop, so you're constantly learning and hopefully improving your processes.
The feedback loop. Okay.
And maybe surprisingly, once the system's up and running, it can actually make the day-to-day bookkeeping a bit easier.
Interesting. Okay, so standards are set. Then we look for the variances, the differences. You mentioned there are different types.
Right. We generally talk about favorable and unfavorable. If your actual cost ends up being lower than your standard or your actual revenue is higher than standard, that's a favorable variance. Good news.
Like finding cheaper gas on that road trip.
Exactly. But if your actual cost is higher than standard or your revenue is lower, that's an unfavorable variance. That's your warning sign.
Something you need to look into.
Precisely. And when you do look into it, it's really helpful to figure out if it was a controllable variance or an uncontrollable one.
What's the difference there?
Controllable means management could have, theoretically, done something about it, prevented it maybe. That means there's an opportunity to act, to fix it going forward.
Okay.
Uncontrollable means it was likely due to outside factors. You know, a sudden spike in global oil prices affecting material costs, something truly beyond the company's influence. Knowing that difference tells you where to focus your energy.
Right, you can't control the global price of copper, but maybe you can control how much copper you waste in production.
You've got it. And when we look at the total cost of making a product, direct materials, direct labor, overhead, that overall difference you might see on a report, that total variance. It's almost always made up of lots of smaller, specific variances underneath.
So you have to break it down further.
Yes, you analyze each piece. Direct materials, DM, direct labor, DL, variable manufacturing overhead, VOH, and fixed manufacturing overhead, FOH.
Okay, let's drill into those first two then. Direct materials and direct labor. You said companies usually look at two specific variances for each of these.
That's right. For both DM and DL, we typically calculate a price variance, sometimes called a rate variance for labor, and a quantity variance, or efficiency variance for labor.
Price and quantity. Okay, what do they tell us?
The price or rate variance tells you if you paid more or less per unit of material or per hour of labor than you expected based on your standard.
So the cost per item or per hour.
Exactly. Then the quantity or efficiency variance tells you if you used more or less material or worked more or fewer labor hours than the standard allowed for the actual number of units you produced.
So how much you use versus how efficiently you used it.
You've nailed it. One's about the price tag, the other's about the usage.
Okay, the stage is set. Let's get practical. How are these actually calculated? Can we walk through an example using the source numbers?
Absolutely. Let's start with direct materials, DM. First, the DM price variance. The formula is actual quantity you purchased times the difference between the actual price and the standard price.
Okay, actual quantity purchased times actual price minus standard price.
Right. So, using an example from the sources, say a company bought 200 units of material. They actually paid $8 per unit, but their standard, what they expected to pay, was $10 per unit.
So they paid less. Good for them.
Yep. The calculation is 200 units purchased times $8 actual price minus $10 standard price. That equals negative $400.
Negative $400.
Which we call a $400 favorable variance. It's favorable because they paid less, $8, than the standard $10. This tells management something went well on the purchasing side, maybe good negotiation, maybe market prices fell.
Got it. Favorable price variance. What about the quantity side?
Okay, the DM quantity usage variance. The formula here is standard price times the difference between the actual quantity used in production and the standard quantity allowed for the actual output.
Standard price times actual quantity used minus standard quantity allowed.
Okay. So let's say the standard price is still $10 per unit, and the company actually used 110 units of material in production. But based on the number of finished goods they made, the standard quantity allowed was only 100 units.
Uh-oh. They used more than planned.
Exactly. So the calculation is $10 standard price times 110 units used minus 100 units allowed. That equals positive $100.
Positive $100.
Which is a $100 unfavorable variance. It's unfavorable because they used 10 more units than the standard called for. This points towards potential issues in production, maybe waste, maybe rework, maybe poor quality materials.
Okay, that clearly separates the price paid from the amount used. Now let's do the same for direct labor, DL.
Sure thing. First, the DL rate variance.
Huh?
Similar logic to the DM price variance. It's actual hours worked times the difference between the actual rate paid per hour and the standard rate per hour.
Actual hours times actual rate minus standard rate.
Example, let's say 450 actual hours were worked. The actual rate paid was $20 per hour, but the standard rate was only $15 per hour.
Ouch. Paid quite a bit more per hour.
Definitely. So 450 hours worked times $20 actual rate minus $15 standard rate. That equals positive $2,250?
Positive again.
Meaning a $2,250 unfavorable variance. They paid $5 more per hour than planned, multiplied across all those hours, maybe overtime, maybe using higher skilled workers than planned. Something drove that rate up.
Okay, unfavorable rate variance. Now, the efficiency side for labor.
The DL efficiency variance. Formula. Standard rate per hour times the difference between actual hours worked and the standard hours allowed for the actual output.
Standard rate times actual hours worked minus standard hours allowed.
Perfect. So standard rate is $15 per hour. We said 450 actual hours were worked, but let's say for the number of units actually produced, the standard hours allowed were 500 hours.
Wait, so they actually worked fewer hours than the standard allowed?
Exactly. They were more efficient. So $15 standard rate times 450 actual hours worked minus 500 standard hours allowed. That equals negative $750.
Negative, so that's favorable.
You got it. A $750 favorable variance. This is great news. The team worked 50 fewer hours than standard to get the job done. Maybe they're well-trained, maybe processes improved, maybe motivation was high. Whatever it was, they were efficient.
Wow, okay, so these calculations really act like like a diagnostic tool, don't they? They pinpoint where things differed from the plan for materials, and labor was at the price we paid or how much we used.
Precisely. It gives you that immediate snapshot of performance, broken down into actionable pieces.
Okay, materials and labor make sense. Now, overhead. This always feels like the trickier one.
It definitely has more layers, yeah. But it's crucial because overhead can be a huge chunk of cost for many businesses.
So how do we approach it? You mentioned comparing actual overhead to applied overhead.
Right. So actual overhead is just what the company really spend on all those indirect costs, factory rent, utilities, supervisor salaries, indirect materials, etc.
Stuff you can't easily trace to one specific product.
Exactly. Now, applied overhead is how companies allocate those estimated costs to the products being made. They use a predetermined overhead rate based on their budget and estimated activity levels. Think of it like estimating postage costs per package before you know the final mailing bill. You apply an estimated
Okay,
cost.
you estimate and apply it, then what?
Then you compare the total actual overhead costs you incurred at the end of the period to the total amount you applied to production during that period.
And if they don't match?
They usually don't match perfectly. If your actual overhead costs are higher than what you applied, that's called underapplied overhead. It's generally unfavorable because you spent more than you allocated.
Makes sense. More cost is bad.
And that difference usually ends up increasing your cost of goods sold, which lowers profit. Now, if your actual overhead is lower than what you applied, that's overapplied overhead.
Which sounds favorable.
It is. It means your actual indirect costs were less than anticipated or allocated. That difference typically reduces your cost of goods sold, boosting profit.
Okay, I get the applied concept and the over-under idea, but that still feels like one big number total overhead variance. How do we break that down like we did with materials and labor? It feels like a bit of a black box.
It absolutely can. You're right. That's why we disaggregate it. We split manufacturing overhead into variable costs, VOH, and fixed costs, FOH. And then within each of those, we calculate specific variances, usually 4 key ones in total.
4 variances for overhead. Okay, let's take them one by one. Variable overhead first.
Sounds good. For variable manufacturing overhead, VOH, we look at 2 things. First, the VOH rate variance, sometimes called the spending variance. The calculation is similar to the labor rate variance, actual hours worked times, actual VOH rate per hour minus standard VOH rate per hour.
Okay, so do we spend more or less per hour on things like indirect materials, electricity that varies with production, etc.?
Exactly. Did the price of those variable items change? It's favorable if the actual rate is lower than standard, unfavorable if it's higher. Second for VOH is the VOH efficiency variance. This one is linked to labor efficiency. The formula is standard VOH rate per hour times actual hours worked minus standard hours allowed for actual production.
Wait, that looks just like the labor efficiency formula, but using the VOH rate instead of the labor rate.
You noticed. That's because we usually assume variable overhead costs are driven by the activity base, often direct labor hours. So if your labor hours were inefficient, more hours worked than standard, you likely consumed more variable overhead too. This variance measures that impact. More hours than standard. Unfavorable VOH efficiency. Fewer hours. Favorable.
Okay, so VOH has a rate variance price and an efficiency variance usage tied to labor. What about fixed overhead, FOH?
Right. Fixed manufacturing overhead, FOH, also gets broken down, but a bit differently because fixed costs don't change with production volume in the short term. The first FOH variance is the FOH budget variance, sometimes called the spending variance. This one's super straightforward. Actual fixed overhead incurred minus budgeted fixed overhead.
So just comparing what we actually spend on rent, salaries, insurance, etc. versus what we plan to spend.
Exactly. Did we stick to the budget for fixed costs? Favorable if actual is less than budget, unfavorable if actual is more. Simple comparison. The second FOH variance is the tricky one, the FOH volume variance. This isn't really about spending, it's about utilization of capacity.
Utilization. How so?
Okay, the formula is budgeted fixed overhead minus the standard fixed overhead cost allocated to production. And that allocated amount is calculated as actual production units times the standard FOH rate per unit or per hour.
Okay, budgeted minus allocated. What does that difference mean?
It tells you if you produced more or less volume than you originally planned when you set your fixed overhead rate. Remember, you calculate that standard FOH rate by dividing total budgeted fixed costs by budgeted activity, like budgeted units or hours.
Right.
So if you end up producing more units than budgeted, you've overapplied your fixed costs. Across more units, you used your capacity well. That results in a favorable volume variance. But if you produce fewer units than budgeted, You haven't spread those fixed costs over as many units as planned. You've underutilized your capacity. That's an unfavorable volume variance.
Wow, so it's not about spending more or less on fixed costs, it's about whether we produce the volume we expected to produce given those fixed costs.
Precisely. Did we make good use of the factory, the machines the supervisors were paying for anyway?
Got it. So just to quickly recap the overhead setup. Step 1, you figure out your predetermined overhead rate budgeted costs divided by estimated activity. Step 2, you apply that rate to the actual activity or standard activity allowed for actual production.
Perfect summary. And then you compare actuals to applied and break down the difference using those 4 variances: VOH rate, VOH efficiency, FOH budget, and FOH volume.
Okay, theory makes sense. Let's solidify this with that Lucy Inc. Widgets example from the sources. Can we walk through their numbers?
Let's do it. It really helps to see it in action. Okay, Lucy Inc. Widgets, data for January, budgeted, 4,000 widgets requiring 1 standard hour each. So 4,000 standard hours.
Produced 3,800 widgets using 3,900 actual labor hours.
Okay, produced fewer widgets, use slightly more hours per widget than standard.
Right, now the costs. Standard VOH rate, $1.50 per hour. Right. Actual VOH rate turned out to be $1 Keynesy per hour, calculated from total actual VOH of $6,240 divided by 3,900 actual hours.
$12,000, which gives a standard FOH rate of $4,000 budgeted hours equals $3 per hour.
Came in at $10,560.
Okay, got the data. Let's calculate the 4 variances. VOH rate first.
VOH rate spending variance. Actual hours X, actual rate standard rate. So 3,900 actual hours X, the $1.60 actual rate, $1.50 standard rate. 3,900 X, the other 10 cents, $390, positive number. So
$390 unfavorable. They spent $0.10 more per hour on variable overhead items than planned.
Exactly. Next, VOH efficiency variance.
Yeah.
Standard rate X, actual hours, standard hours allowed. First, what are standard hours allowed? They mean 3,800 widgets, and the standard is 1 hour per widget. So 3,800 standard hours allowed.
Great. 3,800 standard hours allowed.
Calculation. $1.50 standard rate X, 3,900 actual hours, 3,800 standard hours allowed. $1.50 by 100 hours equals $150. Pause it again.
$150 unfavorable because they used 100 more labor hours than the standard allowed, and that drove up variable overhead costs.
Perfect. Now for fixed overhead. FOH budget spending variance. Actual FOH budgeted FOH.
$10,560 favorable. They actually spent less on fixed costs than they budgeted. Nice work, Lucy Inc.
Definitely a good sign on the cost control front. Finally, the FOH volume variance. Budgeted FOH standard FOH allocated to production. We need the allocated amount first. Standard FOH rate is $3 per hour. Standard hours allowed for actual production were 3,800 hours. So allocated FOH is allowed for actual production were 3,800 hours. So allocated FOH equals $3 by 3,800 hours equals 11,400 hours. Okay, allocated $11,400.
Calculation. $12,000. Budgeted FOH, $11,400. Allocated FOH equals $600. Positive number.
$600. Unfavorable. And this is unfavorable because they produced fewer units, 3,800, than they budgeted, 4,000. So they didn't utilize their fixed capacity as planned.
You've absolutely got it. So let's tally them up. $390 unfavorable VOH rate plus $150 unfavorable VOH efficiency plus $1,440 favorable FOH budget plus $600 unfavorable FOH volume.
Okay, carry the one that comes out to $300. Favorable overall for overhead. $440, $390U, $600D with $300 F.
Exactly. So despite some unfavorable spending on VOH rate and inefficiencies in labor hours, which impacted VOH efficiency and lower production volume, there's significant savings on the budgeted fixed costs more than made up for it, leading to a net favorable overhead variance.
Wow. That example really shows how you can have good and bad things happening simultaneously within overhead. You can't just look at the $300 favorable number and think everything was perfect.
Not at all. Management needs to see all 4 pieces to know where to focus, investigate the higher VOH rate, figure out the labor inefficiency, understand the lower volume, but also maybe learn from how they saved on fixed costs.
Phew. Okay, that clarifies overhead a lot. It's about breaking down that big category into spending versus efficiency for variable and budget versus volume for fixed, disaggregating the black box.
That's a great way to put it, disaggregating the black box to find the real story.
Okay, great transition.
Yeah.
Because the story isn't just about costs, right? It's also about revenue. The sources mentioned variance analysis for sales, too.
Absolutely. You need to analyze the revenue side just as much. Sales variance analysis helps you see how effective the company was at, well, selling stuff, meeting its market goals.
So, similar idea. Actual versus budget.
Yep. The total sales variance is the difference between actual sales revenue and budgeted sales revenue. And just like with costs, we break it down 2 main components here.
Okay, what are they?
First is the sales price variance. This tells you how much of the difference came from selling at a different price than you budgeted.
Actual quantity sold times actual selling price minus standard selling price.
Actual quantity times the price difference. Makes sense. Favorable if you sold for a higher price.
Exactly. Favorable if actual price, standard price. Unfavorable if actual price, standard price. Let's use the Cascade Company example.
Budget.
Sell 3,000 units at $16 each. Actual. Sold 4,000 units at $14 each.
Sold more units, but at a lower price.
Right. So the sales price variance is 4,000 units sold X. $14 actual price, $60 standard price, 4,000X, and give you $8,000.
$8,000. Unfavorable, because they sold each unit for $2 less than planned.
Precisely. Now, the second component is the sales volume variance. This measures how much of the difference was due to selling a different quantity of units than budgeted.
Standard selling price times actual quantity sold minus standard quantity budgeted.
Standard price times the quantity difference.
Sure. For Cascade, standard price, 16 of 6, $4,000 actual units sold, 3,000 standard units budgeted. 16 by 1,000 units equals $16,000. Positive number.
$16,000 favorable because they sold 1,000 more units than planned, and we value that difference at the standard selling price.
You've got it. So for Cascade, the unfavorable price variance, 80K, was more than offset by the favorable volume variance, $16K, leading to a net favorable total sales variance, 8K favorable. But breaking it down tells you why. Great volume, but maybe some pricing pressure.
This seems especially important if a company sells lots of different products, right?
Yeah.
Because just hitting the total sales number might not tell the whole profit story if some products are way more profitable than others.
Oh, absolutely critical. And that brings us to the sales mix variance. This is huge EE for multi-product companies, especially if those products have different contribution margins, selling price minus variable cost.
Right, some products just make you more money per unit.
Exactly. The core idea of the sales mix variance is this. Even if you sell the total number of units you budgeted across all products, if the mix of high margin versus low margin products changes from your plan, your overall profit can be way off budget.
So you hit your overall target, but you sold more of the cheap stuff and less of the good stuff, profit-wise.
That's the gist of it. Calculating it involves looking at the change in the sales mix percentage for each product, comparing actual mix to budgeted mix, and weighting that difference by the product's contribution margin and the total units sold.
Sounds a bit involved. Can we use the Neostar Corporation example? They had two products, Nova and Sunbeam.
Perfect example. Let's walk through it.
So 10,000 total units, mix, 4,000 Nova, 40%, and 6,000 Sunbeam, 60%. Contribution margins, CM. Nova, $5 unit, higher margin. Sunbeam, $4.710 unit, lower margin.
Okay, plan was 40% high margin Nova, 60% lower margin Sunbeam.
Actual results. Still sold 10,000 total units. So their sales volume variance based on total units would be 0. They hit the target. But look at the mix.
Only 1,000 Nova, 10%, and 9,000 Sunbeam, 90%.
Whoa, big shift. Way less Nova, way more Sunbeam.
Huge shift. Now let's calculate the sales mix variance for each. For Nova, the mix shifted from 40% budget to 10% actual. That's a drop of 30%, 10%, 40%.
Actual mix percent, budget mix percent, X total,
Yeah.
actual units, X contribution margin per unit.
Actually, 30% by 10,000 total units, X $5 CM. I will be saying this 15,000.
$15,000.
Yeah.
Unfavorable mix variance for Nova because they sold a much smaller proportion of this high margin product.
Exactly. Now for Sunbeam, the mix shifted from 60% budget to 90% actual. That's an increase of 30%, 90%, 60%.
That's 30% by 10,000 total units. X $4.17 CME equals plus $12,500.
$12,500 unfavorable plus $12,500 favorable stands $2,500 unfavorable.
So even though they sold the exact number of total units they planned, their profit is lower than budgeted by $2,500 just because of the shift in mix. Precisely. That is the aha moment the sales mix variance provides. They sold way more of the lower margin Sunbeam and way less of the higher margin Nova. The overall volume was fine, but the profitability of that volume suffered due to the mix change. That's a critical strategic insight you'd completely miss just looking at total sales.
That's powerful stuff. Okay, we have covered a ton of ground today. We started with standard costs, the bedrock. Then we dug into direct materials and labor price and quantity variances, tackling the beast that is manufacturing overhead, VOH rate, VOH efficiency, FOH budget, FOH volume, and finally looked at sales price, volume, and that crucial mix variance.
It's a journey through the numbers.
It really is, and it shows how these calculations, which can seem complex at first, are actually incredibly powerful diagnostic tools.
And that really is the core value, isn't it?
Yeah.
Variance analysis isn't just about finding numbers that are different. It's about understanding why. Why did we pay more? Why did we use less? Why did the mix shift?
Getting to the root cause.
Exactly. Because understanding the why is what lets management take smart, targeted actions. It's not about placing blame, it's about learning and improving, becoming a smarter, more efficient operation.
So thinking about this for you, the listener, what does it all mean? Well, the next time you look at a company's report, or maybe even just your own personal budget versus actual spending.
Personal variance analysis.
Yeah, you'll have this new lens. You won't just see the final numbers. Hopefully you see the story underneath the story about efficiency, about responding to the market, about strategic choices playing out. And it really makes you think. Knowing how interconnected these things are, consider this. What if you get a really favorable material price variance? You found super cheap raw materials.
Sounds great.
But what if those cheap materials are like lower quality, harder to work with? Could that then lead to an unfavorable labor efficiency variance down the line because your workers are struggling with them, taking more time?
That happens all the time. A saving in one area causing a problem in another. It's never just one number standing alone, is it?
Definitely not. The true insights are always in those variances, and like you said, the connections between them.
Keep digging.
So keep digging into the details of any numbers you come across. You might be surprised what stories they have to tell.